Good afternoon. Welcome everyone to another Iowa SourceLink and Iowa Department of Revenue webinar. We're happy to have you here with us today on this Wednesday, October 12th. Giving everybody a few minutes to sign in and then we'll go ahead and get started. Just a few technical delays, so thank you for coming with us just shortly afternoon here. So it looks like we're going to have a big crowd today. Which is awesome. So we really appreciate you being here. My name is Patrick Linsman. I'm going to be the host for you today for this webinar. I work at the John Papa John Entrepreneurial Center at the University of Northern Iowa, and work with the Iowa SourceLink platform that partners with IDR to bring you these webinars. So we're looking forward to having you here with us. Quick housekeeping to get out of the way. Yes, this session is recorded and it will be sent to you and a link via email and posted on YouTube after the session for you to be able to watch. My colleague Sophie just posted the link to the slides in the chat. You can go download those and follow along as we go through the session today. Be sure to go check those out. For questions, there's a Q&A box in there. I think someone has already found it already and submitted a question for us. So yep, so Nancy, your question is the link to the slides is in the chat. So you can go ahead and get those there and download those. They're also available on iasourcelink.com. We do have, again, a large crowd today. Like almost 600 people have joined us. So please do submit your questions. Either we'll hopefully Carol answer them through the presentation, or if not, super specific, probably have to follow up with you afterwards. Otherwise, we're excited to have you here with us today. Our topic is the 2022 individual income tax update. We've got Kurt here with us. He's the policy director for individual income tax. You can quick see his contact information on there. Kurt, thanks for joining us.
Hey, no problem. Thanks, Patrick. Hey, I'm looking at my screen and I don't see a comment box on here. So if questions pop up, you might have to help me with those if that's okay.
Yeah, absolutely. And also, if you're looking on your wherever you can find your Zoom menu at, there'll be one that's called Q&A, and you can click that and it'll pop open on a different screen for you, and you can kind of follow along in a little bit of that. Okay, well,
they're not jumping up, so if you have some, just feel free to interrupt me. And with that, I'm Kurt Koenig. I'm the individual income tax policy director for the Department of Revenue. I oversee policy related to individual income tax, to withholding, and to trust and estates. This first screen has my contact information. If you have questions about the presentation or about any of those other policy items that I discussed, feel free to reach out with me. I'll be happy to talk with you about that. I hope you like my picture on that opening page. That's kind of my Harry Potter impersonation. When I feel ornery, I do wear those glasses. To start off with, I would like to start with the disclaimer, and I want to remind people that this presentation is intended for educational purposes only. Nothing should be construed as legal advice. The department may take a contrary position in the future, but I'm going to try to give you the best information I can right now. Today, you're also going to hear me say a number of times that we're working on administrative rules related to the current legislation, but we'll have those released as soon as we can. So hopefully that will make your life easier as you're preparing tax returns. If you would like binding guidance from the department, you would have to submit a declaratory order. I've got the administrative rule code section up there that explains how you do that. This slide has our mission statement, vision statement, and value statement. The mission is really to serve Iowans, support state government by collecting all taxes required by law and no more. The vision is for Iowa to be a state where it's easy to understand and comply with the tax obligations for all tax filers. And our values are integrity first, we're dedicated to teamwork, and we are ready to serve. Oh, hey, Patrick, I did find the Q&A thing. Pretty cool. Okay, I'm going to move that to another slide. I thought I'd get that figured out before we were done today.
Awesome.
Here's our overview screen. And this is what I'm planning on covering today. I'm going to go back and I'm going to cover some of the legislation from tax year 22. There's a lot of provisions related to some exclusions or deductions that'll take effect January 1 of 23. We're going to talk about House File 2552. We'll talk a little bit about income statements, 1099s and W-2s. Senate File 2367 allowed for $1,000 exclusion related to some $1,000 payments that went out this last year. We'll cover that. And then I'm going to talk about just some provisions that come into play in 2022. They're not related to current year legislation, but prior year legislation. And then we're going to jump all the way back to 2018, talk a little bit about Senate File 2317, which had some provisions that took effect if certain triggers were met in the state. And those are going to come into play in tax year 23. So income tax for 2023 is going to be drastically different than prior years. And we'll talk through that just a little bit. And then finally, I'm planning on covering some of the common errors that we find with individual income tax returns. And hopefully we can possibly not have as many errors in the future. That would be a win-win for both of us. So with that, let's go ahead and start with House File 2317. We're going to cover just really the individual income tax provisions contained in this bill. This was signed by the governor March 1st of 2022. And we're going to start with the sale of qualified stock by an eligible individual. Now, we're going to go through all the definitions in the next couple slides. But in general, if you have an individual that sells this qualifying stock, they're going to be eligible for a partial exclusion over the next couple of years. Then it will be fully excludable from taxable income. And you can see from the slide in tax year 23, you're going to be able to exclude 33% of the gain from this qualifying stock. In tax year 24, it jumps up to 66%. And then finally, in tax years beginning in January 1st of 2025, all of the gain from this qualifying stock will be excludable. What qualifies? And for this purpose, common stock is going to mean common or preferred stock, voting or non-voting stock is all eligible for this exclusion. And you can see what does not qualify as common stock. That would be the stock rights, stock warrants, stock options, and debt securities. So let's keep digging a little bit deeper into this bill language. Who's an employee owner? So to be eligible for this, you need to be an employee owner of this qualifying stock. And an employee owner is someone that owned qualified stock for at least 10 years. And we're going to explain what a qualified corporation is on the next slide. And the stock was acquired on account of employment by such corporation. We're currently working on the administrative rules. I told you I was going to say that a few times today. I have a feeling we're probably going to link this to employee stock purchase plans. And with an employee stock purchase plan, typically the company will offer stock at a discounted rate to employees. The discounts that I've seen range from anywhere between, say, 5 and 15%. And then the last qualifying factor is that you had to be employed at least 10 cumulative years with the company, the qualifying corporation. So it's not 10 years prior to sale, it's any 10 years prior to the year of sale or the year this election was made. I'm going to jump ahead. I promise you we're going to talk about what a qualified corporation is, and we are right now, as a matter of fact. So to be a qualified corporation, I guess the first thing I want to point out is we're going to look at a corporation at the time that the first election is made to exclude this stock. And once a corporation is a qualified corporation, it's going to be qualified for all sales after that. And again, we'll spell that out in the rules. But what is a qualified corporation? It's going to be a corporation that employed individuals in the state for at least 10 years. They had at least 5 shareholders for the 10 years prior to the sale or exchange. And they had at least 2 shareholders or groups of shareholders who were not related for 10 years prior to the first sale or exchange. So it seems pretty straightforward right now. Who is a related shareholder? And we're going to look, I believe, to Internal Revenue Code section 318, and that identifies who are related, who's related to the shareholders. That's brothers, sisters, aunts, uncles, nieces. Also, the term qualified corporation is going to include Iowa affiliated groups. And for this Iowa affiliated group, they must have employed individuals in the state for at least 10 years. And here's the important bullet point. The affiliated group must have made a valid election to file an Iowa consolidated tax return, and they had to file an Iowa consolidated tax return. So they just can't be eligible. They have to make a valid election and they have to file a consolidated income tax return. And then the final bullet point indicates that corporations that are party to a tax-free reorganization is also going to be considered a qualified corporation for this purpose. Will brokerage houses be required to detail which stock is sold? I don't think that brokerage houses are going to have any information on what a qualified corporation is. This is going to require a lot of communication, I believe, between an individual and the corporation that sold the stock. Again, because once there's one sale and one election is made and a corporation is determined to be a qualified corporation, all sales after that will be considered, that this corporation will be considered qualified for that purpose, but the employee still needs to meet the 10-year employment and the 10-year ownership requirement, and they had to acquire the stock on account of incorporation. There's a lot of questions that are coming in. That's good. One question is, would qualifying corporation be an accounting firm that has an S corporation and they have more than 5 shareholders that are not related? It's possible, but again, remember that the stock has to be acquired through an employee stock purchase plan. And we're going to try to spell out in the rules what an employee stock purchase plan is. So it is possible an accounting firm could qualify if they meet the other requirements. Okay, so an employee owner is entitled to make one irrevocable lifetime election. So again, it's possible that you have an individual that worked for 2 corporations. Both corporations are considered qualified corporations. They acquired stock through an employee stock purchase plan and they held it for 10 years. But remember, you only can make this election on one of those corporations, and that's it. And again, the stock had to be acquired on account of employment. Some other provisions that you should know is that after you do make the election, all subsequent sales or exchanges within 15 years qualify. So the individual could sell their stock under an installment arrangement up to 15 years and it would qualify, or they could sell off individual shares of stock over the next 13 years, 14 years, 13, and still qualify for this exclusion. A question that I've received a couple times that you might have, and we need to address this in the rules, is what happens if I make this election and I sell my stock and I've owned stock for more than 10 years, but I'm having money taken out of my paycheck every period. So I have stock that I've acquired only for the last 9 years, then I have stock that I've owned for more than 10 years. Will all of it qualify? And I can't answer that right now. It seems like the code language states that it had to be held for at least 10 years. So a stock that you just acquired recently may not qualify for that exclusion right now, but we'll try to spell that out in the rules and hopefully get a good answer for you. The qualifying stock, this can be transferred by inter vivos gift. That would be a lifetime gift to my spouse, or I could gift that stock or contribute that stock to a trust for the benefit of my spouse. And those transactions or that stock will qualify for this exclusion also. My tongue didn't work there. Did you hear that? But note that on the date of that exchange where I transferred the stock to the trust or to my spouse, that other individual that I transferred to had to be my spouse on that day for this to still qualify. If an employee owner dies after they sell their stock and prior to the time of making this election to exclude the stock, a personal representative or the spouse can make the election on the tax return for that individual. So that provision could be helpful. Now we're going to jump ahead to the retired farmer lease income exclusion. We've been getting a lot of questions about that. I'm just going to look and see if there's any questions on the one-time stock sale. If an ESOP rolled stock to an IRA, can the IRA distribute stock and exclude this? We're going to talk about qualified money in a little bit. ESOPs, I don't think are going to work in this scenario because typically, if I sell my stock to the ESOP, that, well, depending on how you acquire that stock, that might be eligible for it, possibly not. But the money that comes out of the ESOP is qualified money, and that's going to fall under another provision. Let's jump back to the retired farmer lease income exclusion. This is kind of a big deal. It's effective for tax years beginning January 1 of 23, and you're able to exclude income from a farm tenancy agreement from taxation if you held the land for 10 or more years and you materially participated for 10 or more years. So notice it doesn't say for this provision 10 years prior to the date of sale, it's any 10 years. And again, we'll explain that in the rules. And if you do have a taxpayer that qualifies, you may want to make sure that you can prove the 10 years of material participation, because some people may have been leasing land for 10 years already. And we want to make sure we have some way to substantiate that they did have farming income for 10 years prior to that. The farm tenancy agreement has to be written. Notice that's bolded here. When I practice, I practiced for a number of years, and it wasn't completely uncommon for some neighbors or some family members to operate off of a handshake when they form their lease agreement. And for this purpose, if they want to exclude that farm tenancy income, we need to have a written agreement. Otherwise, this exclusion will be denied. And for the definition of a farm tenancy agreement, we look to Iowa Code Section 562.1A, and there's three types of farm tenancy agreements that are identified. One, you've got a cash lease arrangement, and under that scenario, I might pay my neighbor $280 an acre so that I can farm their land, and that seems pretty straightforward. Or you could have a crop share lease arrangement, and it was fairly common in my neck of the woods to have 50-50 crop share arrangements. And under that scenario, I agree to pay half of the seed expense and fertilizer expense and lime and repairs, and I'll pay for half of the equipment. And in return, I'll get 50% of the proceeds from the sale of the corn and beans. And then finally, you have a livestock share lease arrangement where you substitute livestock for corn and beans. So I might have a cattle operation and I contribute, say, 50% to the cattle operation for the expenses, and in return I get 50% of the proceeds from the sale of that cattle operation. I've had some people ask, what about CRP land? Is that going to qualify for this exclusion? And I don't believe that falls under the definitions for a farm tenancy agreement under 562.1A. So I don't see CRP contracts qualifying for this lease exclusion. I'm jumping over some questions again real quick. I live in an area where many work for John Deere and purchased John Deere stock through an employee stock purchase plan many years ago. Will this stock be qualified? It's possible if they met all those requirements, 10 years of employment, they held it for 10 years and acquired it through the stock purchase plan, and the John Deere meets the requirements for a qualified corporation, it's possible that would qualify. If you're employed by a closely held corporation and you make partner or buy stock, does that qualify? I think on account of employment is going to be tied to a formal employee stock purchase plan. Stock that I just purchase on my own would not qualify for that exclusion. Will surviving spouses qualify? What about a spouse who kept land under, sorry, it's jumping around, a divorce decree, but the other spouse was the farmer on the tax return? We might need to work through that. If you've got a surviving spouse, I believe that we might be pulling forward some of the language from our old capital gain administrative. I'm thinking of the capital gain deduction. A qualifying spouse, we might have to address that in administrative rules. So I can't answer that right now.
Yeah, we had a couple about those too. Same similar question. Does a widow of a farmer who himself would have qualified for this exclusion also qualify for the exclusion? Same question essentially, right?
Yeah, that is essentially the same question. If you've got a spouse of a retired farmer, I've got a feeling the answer might be yes, because I believe that we're going to use some of the language from our previous capital gain deduction rules, and which indicates that if a farmer's spouse materially participated, that participation transfers to the spouse. And I think that the spouse of a farmer, the surviving spouse, it may qualify. I just can't answer that right now. I'm not positive. Here, I'm gonna.
Yeah. You can jump back. I'm trying to keep cleaned up. If we have duplicate questions, I'll try to keep it clean for you to be able to answer them. We do have a lot of people here today, so if we aren't able to answer your question, or if it's a specific question, you may have to reach out either directly to Kurt or wait for some of those other rules to come out. But we do appreciate all of the interaction and in questions. So thank you for submitting those.
Yeah. And there is a question on the farm lease. Does the farm lease have to be executed in order? What date does the farm lease have to be executed? You could have a long-term farm lease that was initiated prior to 2022, as long as it's written. I think you may still be able to qualify for this in 23. I see you updated that. So who's an eligible individual for this farm lease income exclusion? That's going to be an individual who's disabled or is 55 years of age or older at the time of the election. And note bullet point 2, you can no longer materially participate in a farming business. So once I make this election, I should no longer be reporting income on a Schedule F. I should no longer be receiving a K1 from a farming partnership where I'm a general partner. And then bullet point 3 is important also, is that the owner leaser has to be a party to the farm tenancy agreement. So I can't rent land off my neighbor and then turn around and cash rent it to another neighbor. That's not going to work. I need to be the person that owns the land, and I had to meet the material participation requirement as well. And material participation, the definition of that is we're going to focus on Internal Revenue Code section 469H for that, and our administrative rules will explain that a little bit more. I'm not going to go through the definition of what a farming business is or what livestock means, but some of you will feel at ease knowing that emus, they still will qualify for this exclusion. Some of my slides kind of blacked out. So if an individual elects to exclude their farm tenancy agreement, there's some things that they can't do. One thing is they can't claim the capital gain exclusion, which we're going to talk about next, the capital gain exclusion. And they also can't claim the beginning farmer credit in this current year or in succeeding tax years. If you have married individuals that file separate returns, this seems pretty straightforward, but you're going to allocate the exclusion in the same proportion as each taxpayer's net income from that farm tenancy agreement. Next bullet point is important. Partnerships, S corporations, trusts, and estates are not eligible for this farm lease exclusion. Even if the income passes through that pass-through entity to an individual, it's still not going to be eligible for the farm lease exclusion. I have received some questions on disregarded entities. Will they qualify? Can't answer that right now. It seems as though if an entity is disregarded, it may be eligible for that exclusion, but we'll explain that in the administrative rules. I promise we're going to talk about the capital gain exclusion, and we're there. In the administrative rules, we'll have definitions for farming businesses and what held means and what livestock is and material participation. So we're not going to cover those right now. And we'll also talk about what real property is in buildings, but I'm not going to dig in that deep right now on those. Lots of definitions, and they're important, especially when we're drafting administrative rules. I am going to talk about what a relative is, because on the next slide, you're going to find out why. But a relative for this purpose is an individual who's related to the taxpayer by consanguinity, that'd be by blood or by affinity, by marriage within the second degree, or it's an individual that's a lineal descendant to the taxpayer. So it's my parent, or it's my child, or my grandchild. And note bullet point 3, it's an entity in which an individual who satisfies one of those top two conditions and has a legal equitable interest as an owner, member, partner, or beneficiary. So I could have a son that has a 1% ownership interest in a partnership that acquires my real estate, and I qualify for the capital gain deduction. The definitions of a retired farmer are similar to the lease exclusion. You have to be either disabled, age 55 years of age or older, and you can no longer materially participate in a farming business when the exclusion is claimed. So those definitions are consistent, which is important. We're going to start off with farm real estate. This is going to get just a little bit murky, and I'm going to try to talk you through it. So if you've got farm real estate and you sell it, you can qualify for the capital gain deduction if you materially participated in the farming business for 10 years. And notice again, it doesn't say 10 years prior to the date of sale. It's any 10 years. And I had to hold that property for 10 years to qualify for the real estate exclusion. Or bullet point 2 is important. I held the property in a farming business and I sold it to a relative. So if I have real estate and I sell it to that partnership where my son has a 1% ownership interest in it, that qualifies for the capital gain exclusion as well. Okay, let's keep digging. Okay, now we're going to dig into livestock. So it gets a little more confusing now. I can sell that real estate almost anytime. We do have some exceptions to it and qualify for the capital gain deduction. But if I've got breeding livestock, if I've got cattle or horses, my holding period is similar to the old capital gain deduction rules. I had to hold it for 24 months and I have to be retired. And remember, under the old capital gain rules, they said if you're a retired farmer, you only have to hold it for 5 of the 8 years preceding the date of retirement. So now it's not like any 8 years. This is 5 of 8 years preceding the date of my retirement, my disability, and I have to sell substantially all my interest in the farming business. So when I get down into the livestock, I've got to be retired. I've got to sell substantially all my farming business. And then you're also able to deduct breeding livestock other than cattle and horses. And the holding period on this is 12 months, which is consistent with our old capital gain rules. And again, I have that 5 of 8 years preceding the farmer's retirement stipulation, and I had to sell substantially all my farming business. Okay, so a retired farmer can make a single lifetime election to exclude the real property, the cattle and the horses, and breeding livestock. So this is when I'm liquidating everything and I want to sell my breeding livestock and my cattle and horses. Prior to that date, I could sell the real estate and I don't have to be a retired farmer. And I'm eligible, assuming I didn't take the farm lease exclusion or I didn't make another single lifetime election. Then the rules kind of get murky, but the real estate kind of stands on its own until you liquidate your whole farming business. Then I've got to make the single lifetime election. And once I do make that single lifetime election, I can't claim the beginning farmer credit in the same year or subsequent years. And I can't claim the farm tenancy agreement in the current year or succeeding years. So at some point, a farmer is going to have to make a decision. Do I want the capital gain deduction exclusion, or do I want to claim the farm lease exclusion? If you have married individuals who file separate returns, you're just going to allocate this exclusion in the same proportion as that you report the total income on your return. Installment sales, this is a big deal. Prior to House File 2317, our old capital gain rules were scheduled to be repealed January 1 of 23, except for real estate that was used in a farming business, and all your old installment sales that were previously eligible for the capital gain deduction were going away. And House File 2317 brought that back. So if you have a sale that was initiated prior to January 1, 23 that qualified under the old rules, and you claim the capital gain deduction in prior years, you're going to be able to report that capital gain deduction in future years as well. I think that's a win for taxpayers. I'm going to peek over here and see if there's another question I can answer quick. If you transfer farmland out of trust, do you think that you'll be able to qualify for the capital gain exclusion? Again, if you transfer out of trust, I think you're still going to have to meet that material participation at your level. If it's a revocable trust, that's a disregarded entity, and that may work because the trust isn't recognized for tax purposes, but you still need to materially participate and own that for a 10-year period. Yeah, for the retired lease income exclusion, we're in the process of developing forms for the new capital gain deduction and for the farm lease exclusion. I don't know if that's going to be a 100 series because it's not really a capital gain deduction. It might be something other than 100, but I anticipate it's going to be numbered somewhere near that. For the capital gain deduction, I saw something about an S corporation. I'm sorry, these are bouncing up and down. If you have lease income from a S corporation, that's not going to qualify. Remember, I pointed that out on the slide. But if you do have a capital gain that passes through a pass-through entity, a partnership, that I believe may still qualify for this capital gain deduction.
There's one in here, Kurt. Can husband rent land from a spouse, and if spouse claim the exclusion while the husband continues farming?
I believe that we're going to be viewing both taxpayers together. So I don't think there's going to be a way to essentially double dip on this. But I don't know for sure. That's certainly something that needs to be spelled out in the rules.
And then a question was, do you have to be an Iowa resident? And I think maybe to extrapolate on that, I'm assuming it's you own land or have land in Iowa or property in Iowa and you no longer live in Iowa. How does that kind of?
I don't think this provision is Iowa specific. So if you're required to file an Iowa tax return and you have a transaction that may qualify for the capital gain deduction or the farm lease exclusion, I think that you'd be eligible. It doesn't have to be Iowa real estate. That's not stipulated in the code.
All right.
Okay, I'm going to jump ahead. And Patrick, feel free to jump in when you see some good questions for me.
Yep.
On this next slide, I've got the income tax brackets for tax year 23 through 26. You can see that the top rate drops down from 6% to 3.9%. This slide is for taxpayers other than married filing jointly. If you are married filing jointly, the income tax bracket limits, those will double. So the first bracket will go all the way up to $12,000, and that final bracket will just start at roughly $150,000. And here's the alternate tax rates for tax year 23 through 26. Okay, retirement income exclusion. I kind of touched on this a little bit ago, but House File 2317, it removed the cap on the retirement income exclusion, which is a really big deal. For married taxpayers, they were able to exclude the first $12,000 retirement income they received at their age 55 or older or disabled, and all other taxpayers were able to exclude $6,000 for retirement income. And the caps removed. So taxpayers that are age 55 or older or disabled won't pay any income tax on their retirement income, which is a really big deal. I've said this maybe once or twice before, we're working on the administrative rules, and in those rules, we'll define exactly what retirement income is, just so everybody knows, and we're trying to do that as soon as we can. And we're working through the withholding rules related to this also. Currently under Administrative Code 46.12, we do have a provision that says no income tax is required to be withheld if to the extent that the income is not taxable in Iowa. So for new retirees, I don't think that you'd be required to withhold, but I think in the rules we're going to make it clear whether you need to make an election to exclude. I know a lot of you right now that are retired might have filled out a W-4P form, and it asks what you want for withholding and what exclusions you want to claim, but it doesn't seem very useful to have people fill out a W-4P form just to claim that they're excluded from taxation. But we do have another rule that kind of creates a problem right now. It's 46.12B that says that if an individual has made a withholding election, that the administrator is required to honor that until they file a new election. So that would need to be addressed. I don't know if you can just stop withholding right now until we update this administrative rule. Another important change related to the retirement income exclusion is the top portion of this. And this relates to who's required to file an individual income tax return in the state of Iowa. If you're filing married, filing joint, or head of household, or you're a surviving spouse, and you're under age 65, generally you don't have to file an income tax return if your income is below $13,500. If you're 65 or older, it's $32,000. And then for all other taxpayers, you can see those limits are $9,000 and $24,000. Under the current rules, you need to add back in part the retirement income exclusion. So to qualify for the $13,500, I need to add back, say, the $6,000 retirement income exclusion that I claimed on my return. House File 2317 removes that add back requirement, so I can exclude all my retirement income, and I don't need to add it back to the $13,500 to determine whether I have to file a return. So there's going to be a lot more taxpayers in the state of Iowa that will no longer have a filing requirement. I think that's a good thing.
One question that did jump in here, about three with the same question, is would a Roth conversion be considered retirement income? Or
Yeah, that's a great question. I've received that a number of times. I don't see any difference between a Roth conversion and pulling money out of an IRA. I believe that Roth conversions are all going to qualify for the retirement income exclusion. Now I'm going to roll forward to House File 2552. This was signed by the governor May 2nd of 2022. It has a few items in here that I think are important to you. The first section up here was kind of cleanup language where our code language and our guidance was inconsistent on when taxpayers were required to file income statements, 1099s and W-2s with the department. I believe the code language said the last day of the second month, and all of our rules and other guidance indicated February 15th. And now all that's consistent. February 15th is the date that we always publicize, and that's the date that we want those W-2s and 1099s. And then we've also removed the VSP filing requirement. Back in the day, VSPs were important. That VSP form summarized all the withholding on your W-2s or your 1099s, and it gave us a number to match to our system to make sure that it tied to payroll reports and tied to all the payments that came in. But we've moved over to a new modernized system, and hey, we have a calculator that can add up numbers. So we don't need that VSP form. Everybody's required to submit the W-2s and 1099s electronically. So we have all the withholding information, and we have all of your withholding reports on GovConnect Iowa. So we removed that, so that should reduce the burden for the preparation community. Next item is big. House File 2552 provides for a $500 civil penalty for And there's a couple situations where this comes into play. One, an employer or payer willfully fails to furnish W-2s or 1099s to employees, to payees, or to the department, or they file false or fraudulent statements to the employees, the payees, or the department. How will this work? Let's assume that you've got an employer that has 10 employees and I willfully fail to furnish any W-2s to them. Potentially that employer could be subject to first a $500 penalty for 10 employees, $5,000, and then an additional $500 penalty for not providing those W-2s to the department. So $5,500 for willfully failing to furnish those W-2s to the employees and to the department. So kind of a big deal. Make sure that everybody gets their W-2s filed. I want to let you know that we don't plan on issuing these civil penalties on February 16th. The intention right now is not to look at accounts and go, wait, we didn't receive the W-2s. We're assessing that civil penalty. We think it's important that the employees get their W-2s, for instance, in a timely manner so they can meet their tax filing obligations. And the department wants that information so we can code it in our system so we can do matching so we don't have to send out letters to have taxpayers confirm W-2 amounts. So compliance is the important thing. If somebody just willfully won't file them, then we plan on assessing this $500 civil penalty. I'm going to jump ahead to Senate File 2367 now. And the provision I'm going to talk about is the premium pay exclusion. There was a number of individuals in the state last year that received $1,000 payments from the state or from certain agencies. At the time that most of these payments went out, this exclusion wasn't passed yet, so there was withholding on those payments that went out. And there are some individuals that were not state employees that received money from the state, and they received 1099 forms that'll be subject to income tax. But after the passage of this bill, that income is going to be tax-free. Your clients or you should be aware, and they should notify their tax preparer. I received this money. Here's my letter. Exclude that income. And those payments went to certified peace officers. They went to correctional officers. They went to teachers, and they went to child care workers. You're going to claim the exclusion on line 14 with a code of AA. It's a new code for this year, and that's where you're going to report that $1,000 exclusion. Here's some other provisions related to tax year 22. Somebody asked about the 2022 tax rate. So, hey, we're going to get there in just a second. The qualified business income deduction, DPAD deduction, the allowable percentage increased from 50% to 75% for tax year 2022. And in tax year 23, it's going to jump up to 100%. And here's your tax rates for 2022. The brackets just changed a little bit. Our top rate is still 8.53% for income over $78,435. I believe everybody gets a copy of this slide deck, so you'll have this for your records. Here's the standard deduction for tax year 22. Married taxpayers filing jointly. The standard deduction is $5,450. For all other taxpayers, it's $2,210. And here's the first-time home buyer savings account deduction limit. And that jumps up just a little bit in 2022 for married taxpayers filing joint, $4,363. For all other taxpayers, it's $2,181. And then for people that make contributions to college savings plans, that went up just a little bit also. You can deduct $3,522 per beneficiary. Just remember the contributions have to go to Iowa plans to take the deduction on the Iowa return. We haven't had a change in our standard mileage rate in a long time for the state of Iowa. If you itemize your deductions and you have charitable mileage, the allowance rate increased July 1 of 2022 to 50 cents per mile. So this year will be kind of one of those transition years. Your miles from January 1 through June 30, you can use a 39-cent per mile rate. And then after that, it'll jump up to 50 cents per mile. And then when we go to 23, I hate to ruin the surprise, but we're going to use the federal itemized deduction, and this will go away. Here's something that's brand new for this year. Iowa composite credits. For tax years beginning January 1 of 2022, your business pass-through entities, your partnerships, and your S corporations are required to withhold income tax on non-resident beneficiaries. And those non-resident beneficiaries are going to receive a Schedule CC to report their share of the income and their share of the withholding. And when you receive these statements, you're going to report those on line 62 of the Iowa 1040. And then with the trust returns, that withholding requirement is not going to start till January 1 of 23. And then trusts will be required to withhold at typically the highest individual income tax rate for non-resident beneficiaries of trust as well. Okay, now we're going to jump back to 2018. This is the provision we're talking about where it makes a substantial change to Iowa's income tax. We think there was a number of triggers that were involved in this. Those were all removed by House File 2317. I know we're getting down to 10 minutes, so I'm just going to jump right into this. Here are some of the big changes that I want you to be aware of. One, the starting point for Iowa individual income tax is going to be federal taxable income. Previously, it was federal adjusted gross income. Now it's federal taxable income. So that means after the federal standard deduction, after the federal itemized deduction, we're in the process of completely revising the Iowa 1040 form. It's going to look substantially different. The top section's a lot shorter because we're starting with federal taxable income, and then we're going to have a modification schedule for some of these other items that I'm about to talk about. First, net operating losses. Once we get into tax year 23 for tax year starting January 1, 23 going forward, whatever NOL you calculate on the federal return is going to be allowed on the Iowa return. Those are for losses after January 1 of 23. If you have a loss that occurred prior to 23, then we're going to have to make some adjustments. The federal loss that's reported in the federal return, we're going to pull that off of the return on the modification schedule. And then if you have an Iowa NOL that's carrying forward, we'll take that deduction on this new Iowa modification schedule. And those Iowa losses that are carrying forward, I believe those are still going to be able to offset all the taxable income. And there's going to be a 20-year carry forward for those Iowa NOLs that are rolling forward. The married filing separately on a combined return, that status is eliminated from January 1 of 23. AMT is going to be repealed. That's a good thing. One less calculation to do. There's going to be a 1-year allowance for that AMT credit. So if I'm subject to alternative minimum tax in tax year 22, in tax year 23, I've got 1 year to claim some of that credit carry forward on my return. Federal deductibility, federal taxes, the deductibility of those goes away January 1 of 23. And there's going to be a transition with that also. On your 23 return, you're going to be able to deduct any taxes that you paid for tax years prior to 23 on that final 2023 return. I believe that's also going to include possibly any federal individual income tax estimate you paid in January of 23 for 22. You'll be able to deduct that on the 23 return, and then any refunds that you receive in 23 for tax years prior to 23, you're going to add those back on that final return also, and then the federal deductibility goes away. Some other adjustments of interest, starting January 1 of 23, taxpayers are going to be able to subtract income from student loan repayments that were paid by the employer. So the employer pays off your student loan for Iowa purposes. You won't have to pay tax on that, like forgiveness of debt. It won't be taxable for Iowa purposes. This provision also had its own capital gain exclusion. Previously, after January 1 of 23, only capital gains related to farm real estate were going to be eligible, but we talked about the capital gain the new capital gain exclusion earlier, and that's what's going to carry over. Health insurance premiums. Most of you know that if you pay for health insurance post-tax, you're able to take an above the line deduction for the amount of that health insurance that was paid post-tax. When we roll into 23, those rules are going to change some, so that the only individuals that are able to deduct that health insurance premium without itemizing are taxpayers that are age 65 and older, and they have income of less than $100,000. They need to meet both those requirements. You got to be 65, and your income has to be less than $100,000. There's a lot of provisions that were removed in this bill. A lot of these were cleanup things that we don't, that haven't been used for a number of years. A couple things on here that might be of interest. This line right here, travel expense for legislators, that's removed this year. And that's something that has been used by some of our state representatives. There's a lot of things for like bonus depreciation cleanup in section 179. We conform with the federal rules right now. So on new tax filings, there should be no difference between the section 179 or bonus depreciation, whatever was claimed on the federal return is what you'll claim on the Iowa return for your current year acquisitions. I highlighted a couple of items on this page. The teacher expense deduction, that was going to be repealed, but that was reinstated last year in House File 847. They've repealed the qualified tuition expense deduction. This was repealed at the federal level, so that's different than the tuition and fees deduction that we have at the Iowa level. I just wanted to point that out so people didn't think, oh my gosh, we're going to lose our tuition expense. No, those are two different provisions. I wanted to make sure you're aware of it. And then if you file trust returns, in the past, if you had administrative expenses that weren't allowed as a deduction on the federal return, you were able to take those on the Iowa return, but rolling forward for tax year starting January 1 of 23, those administrative expenses won't be allowable unless they're allowed for federal purposes. Here's some things that were not repealed. The pension exclusion, thank goodness, because we talked a lot about that earlier, didn't we? Retirement pay is not taxable if you're age 55 or older or disabled. So you're still able to take the pension exclusion. The military pay and retirement exclusion, you're going to be eligible for that. First-time home buyer deduction. And then there's certain state exempt bonds that we identify in our rules. The interest income from those state bonds still won't be taxable for Iowa purposes, and interest on federal securities won't be taxable for Iowa purposes either. For those of you that prepare more than 10 tax returns, I will remind you that there may be an annual filing requirement when you're required to have 15 hours of continuing education if you're not specifically excluded from those provisions. Typically, those are licensed individuals, attorneys, CPAs, and enrolled agents. But just make sure that you submit those reports in a timely fashion. Here's some common errors that we find when people have been submitting their annual CPE report. Just make sure you have all your numbers, you have all your course titles filled out, and sign it. There's a number of them that we received that weren't signed, so we want to make sure that all those are signed. And here's some common errors. And Patrick, do you have some questions that may need to be answered before I get into some of the common errors?
One we've got here. Did you say that federal taxes paid will still be deductible on the 2023 tax return? Yep.
That'll be the last year you can do it. In tax year 23, I can deduct federal taxes that were paid for tax years prior to 23, and that's the last year you'll be able to do that.
All right. Will self-employed health insurance still be allowed as an Iowa deduction?
Yeah, I believe if that's allowed at the federal level, it's going to be allowed for Iowa purposes because we're starting with federal taxable income. And I think that health insurance deduction that I pointed out would really just apply to individuals other than self-employed individuals. So that was an Iowa specific provision.
Yep, I would say, because we only got a few minutes left, why don't you go ahead and try and finish through some of these common errors that you see, and then if there's any time left, we'll try to grab a couple more questions.
Okay. Here's some of the common errors. I put the link on here to our webpage that has the full list, but some of the most common things that we find, first of all, taxpayers don't pick up the amount of their federal tax refund from the prior year on the current year tax return. Taxpayers are allowed to deduct federal taxes on the Iowa return. So in turn, if you received a benefit, you're required to report that refund on the Iowa return. A second item, incorrect school district. I understand that taxpayers move. I was a tax preparer for a number of years, and I did have a number of clients that lived in rural areas, and sometimes they weren't completely aware of which school district they technically sat in. They might send their kids to one school, but they're technically in another one. A couple places where you can identify which school district you should be in. I believe the county assessor records indicate which school district you're in. And then something that's probably even easier yet is you can go to the Iowa Department of Revenue webpage and type in tax-mapper, and we have a page where you can input an address, and among other things, it tells you what school district that resident's in, and that's helpful. And just an FYI, that's what we use to check. So that would be a good thing for you to use to confirm the school district. The amount of income tax withheld and estimated tax payments that were made. Sometimes there's a difference between those. I probably see the most errors related to estimates. And I know when I was in practice, I'd ask a client, did you pay your estimates? And they'd say, yep, I did. And I paid them on time. And then you'd find out that they skipped them and they changed dollar amounts. It'd be helpful if everybody would write down the date they paid and the amount they paid so that everybody has accurate information to submit to the department. And typically, if withholding was missing, a lot of times the income associated with that withholding was missing from the return also. So make sure you have all your W-2s, all your 1099s. With the health insurance deduction, again, if you claim the health insurance deduction on the Iowa return above the line, you had to pay for that health insurance with post-tax dollars. If it went through an employer plan and they paid the health insurance pre-tax, you're not eligible for that health insurance deduction.
Kirk, can you real quick repeat where you look for the correct school district?
It's tax-mapper. If you search that on the Iowa Department of Revenue webpage, tax-mapper, M-A-P-P-E-R.
All right, thank you.
Yeah, no problem. And then we just got a minute left. I'm just going to cover this slide quick. Name and address. Make sure you're using legal names on the tax returns and their legal address on the tax return. You might have individuals that have source income from Iowa of more than $1,000, and we usually have errors where maybe an individual has over $1,000 of income, but then they look at, remember I had a slide earlier that said you're not required to file if your income was less than $13,500 or $9,000. If you have Iowa source income of $1,000 or more, you're required to file a return, unless all of your source income is less than those limits that I posted earlier. Some people seem to think, well, I just had $1,000 or $2,000 of Iowa source income, I don't have to file. Technically, you do have a filing requirement. We have errors with the non-resident and out-of-state tax credit forms. A lot of people don't completely understand that you complete the full 1040 return, reporting all source income on there, and then you use either the Iowa 126 or Iowa 130 form to calculate your out-of-state tax credit that you're going to report on the return, or you're going to get credit for the tax that you paid to another state. And then I think the last thing I just want to hit is that if you file a paper return, make sure that you get a signature on the return. I know a lot of people are used to submitting returns electronically, and their clients can just sign a form and you put it in your folder. The one that you send in, we actually need to have a signature on that, and we need copies of all the W-2s, all the 1099s, anything that had withholding. There might be a K-1 that had withholding on it, and we want a copy of that. But with that, I think I'm going to go ahead and just stop there, Patrick, since we're at the top of the hour right now. So does anybody have any questions for me?
Yeah, so if you want to go ahead and look quickly through the questions and find something you want to answer, The slides are available and they'll be available after the webinar. This has been recorded. You'll be able to rewatch it as well. It'll be posted up on isourcelink.com. We do have 2 more webinars yet this year, one on November 9th for our pass-through entities update, and then on December 14th for electronic submission of W-2s and 1099. So be sure to register for those and come back. We do have quite a few outstanding questions still, so maybe we'll take just a couple minutes to answer a few. If you have some specific questions or specific questions for Kurt or on this topic, his contact information is included in the slides, and you can be able to reach out there or reach out to the department to be able to get some of those answers. So Kurt, I'll sort of leave it to you for just a couple of minutes. Any you want to see that you want to answer?
Okay, I'll cover a couple of these. There's a few related to the capital gain exclusions. And I want to clarify with the installment sales, if you have an installment sale that qualified prior to January 1 of 23, and you sold the property on an installment under an installment method, you're going to be able to still qualify for that capital gain exclusion even after January 1 of 23. Previously, that was going to be repealed, but that's still going to be eligible for the capital gain deduction. And then for sales on or after January 1 of 23, the only sales that will qualify for the capital gain deduction will be the farm-related ones, which involve the breeding livestock or the real estate. And those sales can be on an installment method also, but it's only going to be farm-related sales that occurred after January 1 of 23. What about the filing requirements? Will we have to file and report the retirement income like we currently report Social Security income? We're going to start with the federal taxable income on the Iowa return in 23. So your retirement income is going to be included in your federal taxable income, but we're going to have a modification schedule where you can back out that retirement income for eligible taxpayers so they don't have to pay tax on it. For those who are over the income limitation, will they still have the exclusion available? I wonder if you're talking about the income limitation for filing a return. That's a good question. That income limitation that I think you're talking about just identifies who is required to file an Iowa income tax return, and that's separate from the exclusion. There is no income limit on the retirement exclusion. So any retirement income for qualifying individuals won't be taxable in the state of Iowa. There's no limitation on that. Will inherited IRAs that previously qualified for the $6,000 and $12,000 exclusion because of the decedent's age still qualify for the exclusion? I believe the answer to that is yes. It might have to be addressed in our rules, but I believe those would qualify. Will deferred comp be considered retirement income? Deferred comp, that we're going to have to address that in our rules. So I think that retirement exclusion is going to be tied to qualified income, and I'm not sure if there is a qualified deferred compensation arrangement. But I don't know that is going to qualify for the retirement income exclusion. Is Social Security income excluded from retirement income taxes? Yes, Social Security still won't be taxable for Iowa purposes.
Go ahead.
I was just thinking the next one is the federal government thrift savings income, which they say is substantially like a 401k for military and civilian personnel exempt from tax. I believe that TSP is considered qualified. Again, we'll have to spell that out in rule. It's my understanding that that may qualify, but I can't give a definitive yes or no on that.
Yep. All right, so we got 106. So 2 last quick things. Roth conversions. Will those amounts be excluded under retirement income? We had a couple of people ask about that again. So can you clarify the Roth conversion income will qualify for the retirement income exclusion?
Yep, that's my understanding, is that if you do a Roth conversion, that will qualify for the retirement income exclusion, assuming you meet the age or disability requirement.
All right, and then the last one is, did you say that the fourth quarter 2022 estimate paid in January of 2023 would or would not be deductible?
Yep, I believe that that will be deductible. And then on that final 2022 return, the final tax liability on that 1040 related to that estimate of the refund will also be reported on the 2023 return. So answer yes, I believe that will be allowed as a deduction.
All right, well, I think we'll wrap there. It's a little bit past the hour. Kurt, thank you so much. As always, this presentation has a ton of different information. You do such an awesome job of presenting it. This has been recorded, so you'll be able to watch the recording on iasourcelink.com, as well as YouTube. The slides are available there. And then you can also, we'll be sending out for everyone that attended and everyone that missed it, reminders for you to be able to get those slides and view the video. Be sure to check out iasourcelink.com or the Iowa Department of Revenue's newsletter list, like ones we can see here on the slides, to sign up to get updates on all sorts of topics, including the last couple webinars that are coming up yet this year. So, Kurt, great job. Thanks again. And for everyone else, hopefully see you back in November.
Thanks, everyone.